Think living abroad shields you from the IRS? Think again. The era of practical obscurity for Americans overseas is officially dead. Today, the IRS is leveraging automated data matching, AI, and international treaties to aggressively target high-income expats, offshore bank accounts, and foreign investments. In this video, we are breaking down the top 5 IRS audit red flags for expats, the massive penalties attached to them, and the exact legal amnesty pathways you can use to protect yourself. Let's dive in. First up is red flag number 1, automated underreporter discrepancies, also known as the CP2000 mismatch trap. The IRS relies on a massive automated computer system called the AUR program. This program automatically cross-references whatever you report on your Form 1040 against the tax forms submitted by third-party employers and financial institutions. Here is the expat trap. The automated matching software uses simplistic algorithms. It does not automatically reconcile the foreign earned income exclusion on Form 2555 or the foreign tax credit on Form 1116. So, if a U.S. employer reports your gross wages on a W-2, but you exclude that income using the foreign earned income exclusion, the computer flags a massive variance and automatically shoots you a CP2000 notice. This also happens constantly with U.S. brokerage accounts, crypto trading, reported on Form 1099-DA and third-party payment platforms like PayPal, which have strict automated reporting thresholds. So if you get CP2000 notice, you have 60 days as an expat to respond with supporting documentation before the IRS automatically assesses penalties and starts collections. Do not ignore your CP2000 notice. Red flag number 2, asset reporting mismatches between your FBAR and Form 8938. As an expat, you have to deal with 2 completely separate offshore reporting frameworks. The FBAR filed with FinCEN and Form 8938 filed directly with the IRS. Because foreign banks in over 100 countries report your balances directly to the IRS under FATCA, the government already knows what you have. If your FBAR shows high peak balances, say over 500,000, but your Form 1040 Schedule B reports zero interest or dividend income, the system immediately flags your return for an audit. And the legal landscape here has turned brutal. In early 2026, the Second Circuit Court of Appeals ruled in United States versus Reyes that reckless disregard, like simply checking no on Schedule B or failing to inform your accountant about a foreign account, can legally count as civil willfulness. That strips away your ability to claim ignorance and exposes you to mandatory 6% late penalty plus a willful penalty that is the greater of 165,353 or 50% of your account balance. Red flag number 3, unreported foreign gifts, inheritance, and foreign trust. If you receive a cash transfer or inheritance from a foreign individual or estate that aggregates to more than 100,000 in a year, you are legally required to file Form 3520. International wire transfers leave massive electronic footprints. The IRS aggressively tracks this, and the failure to file penalties are among the most severe in the entire tax code. If you miss the deadline for a foreign gift, The penalty is 5% of the gift's entire value for every month it's late, maxing out at 25%. If you think the IRS can't just slap you with these penalties without a lawsuit, think again. In May 2026, a federal court ruled in Zhang versus IRS that the IRS has explicit statutory authority to administratively assess and collect these massive foreign gift penalties without even filing a lawsuit first. Keep a strict eye on deadlines. Form 3520 is generally due on June 15 for expats and cannot be extended past October 15. Form 3520A, on the other hand, is due March 15 and can be extended to September 15. Red flag number 4, passive foreign investment companies or PFICs. This is the most common accidental trap for expats. If you live abroad and buy local mutual funds, unit trusts, or ETFs through your foreign bank, the IRS classifies nearly all of them as PFICs. You are required to file Form 8621 annually for each individual fund you hold. If you don't file it, you fall into the default Section 1291 excess distribution taxation regime. This allocates your investment gains across your entire holding period, taxing prior years hypothetically at the highest historical individual marginal tax rate plus compounding interest. To make matters worse, under Tax Code Section 6501C8, failing to file Form 8621 suspends the statute of limitations for your entire Form 1040 tax return indefinitely. It means the IRS can come back and audit your whole return prior years later unless you can prove reasonable cause. Lastly, erroneous foreign earned income exclusion or foreign tax credit claims by remote workers. If you claim the foreign earned income exclusion, you must strictly pass either the physical presence test, meaning 330 full days outside the US, or the bona fide residence test. Under modern AI-driven enforcement, the IRS doesn't just take your word for it. The IRS routinely requests U.S. Customs travel data history, passport scans, flight logs, and even review public social media footprints to verify exactly where you were on any given day. Under Section 911, if your economic and personal ties, your true abode remain in the U.S., you cannot claim a foreign tax home. Remote workers working for U.S. companies while floating on tourist visas are prime targets for complete disallowance. If you realize you've triggered one of these red flags, do not panic. The IRS provides legal, penalty-free amnesty pathways to catch up, but you must act before they contact you. For non-willful expats, the Streamlined Foreign Offshore Procedures is an incredible program. It allows you to file 3 years of back tax returns and 6 years of delinquent FBARs. Under this program, the IRS waives all late filing, accuracy, and miscellaneous offshore penalties, giving you a 0% penalty rate. However, if your past omissions were willful or border on the new reckless legal standard, you can utilize the voluntary disclosure practice to pay back taxes and secure absolute protection from criminal prosecution. Seek help from a qualified U.S. tax attorney. Tax compliance as an expat is incredibly complex, but knowing these red flags is half the battle. Drop a comment below if you've ever dealt with an FBAR or CP2000 mismatch notice. Speak to a qualified U.S. tax professional before making a filing decision.